you, sir, for joining us at a very short notice. I hope you, your family, and everyone at Kotak Mutual Fund are doing well. For the interest of our viewers, Mr. Nilesh Shah needs no introduction. He's the chairman of Association of Mutual Funds in India and also the managing director at Kotak Mahindra Asset Management Company Limited. The reason we, kind of requested him to have this call for our investors is primarily for the reason because he is one of the few industry thought leaders who speaks from a language which most investors understand. So the way we have structured this discussion is going to be on two broad parameters. One would be on market discussion, and second would be on behavioral finance. While we understand that we are living in a world of imperfect information where things are dynamically changing, but we feel that it is the investor temperament and the behavior he demonstrates in these times which makes an investor earn optimal versus suboptimal risk. Without any further delay, I would like to hand over to Harsh for the discussion on market. Over to you.
Good afternoon, sir. Thank you for joining at such a short notice, and I really hope everyone at your end is safe and sound. So the first question, sir, which we have is about apprehensions about equity market. So some analysts are saying that we are in recession, while some are saying that we are in Great Depression. Now, I'll try to take a step back and connect to what Mr. Warren Buffett said in Berkshire Hathaway's annual meeting, where he showed the data from 1930s to 1950 in United States, and we saw that Dow Jones didn't give any return for 2 decades. Generally, when we recommend equity to our investor, we tell them to have a time frame of 8 to 10 years. Now, the apprehension which we as advisors and our investors have in their mind is that could we have a phase like US was in from 1930 to 1950 of, a decade or 2 decades where we practically make no return or subdued return on equity market in India?
So Harsh, if you read the book Lords of Finance, it shows that central bankers of those era pulled back monetary stimulus way early, and that resulted into economies collapsing and depression becoming Great Depression. We also saw devastation of Second World War, and that prolonged Great Depression. So if we take out these two aspects, Second World War and relatively early withdrawal of monetary stimulus, then the pain period of that era will come down dramatically. Unless until you believe that central bankers will be bystanders and Third World War is likely to begin, then I don't think so. We should be worried about this bear phase in market lasting as much as 1929 Great Depression.
Thank you, sir. And thanks for the answer, and also thank you for recommending something good to read. So my second question is about, so first was about general apprehension about equity market, and second is about valuation. While most of the experts believe that FY21 is going to be washout, and we also understand that in equity market, terminal value is most critical, and it has the exponential power in terms of discounted cash flow. So if we go by the hypothesis that FY21 is going to be zero growth or negative growth, and the growth will start from FY22, where are we at this point of time in terms of valuation? Are we cheap? Are we fairly valued? Are we expensive?
So there are two ways to look at this thing. Today, market knows that COVID-19 is creating uncertainty on economic activity. Stoppage of economic activity is creating financial market problem. Now, if actual situation over next 1.5 year is far worse than what is discounted by the market, then prices will correct further from here. If it is actually far better than what is discounted by the market, markets will go up. So one thing is what we have estimated versus what is the reality. During 9/11, airline stocks opened at a significant bottom level post 9/11. Over next 1 month, airline stock became the best performing sector because while opening at bottom, airline stocks were discounting that now airlines will not fly. There will be more marshals than passengers on plane. The actual reality was far lower in terms of worseness than what was priced by the market, and hence airline stock became best performing sector. The second way to look at this is from a valuation point of view. Today, we don't know anything about earnings over next 4-5 quarters. Companies don't have visibility and hence they are not giving guidance and we won't be able to forecast. So let's look at on a price to book basis or a market cap to GDP basis. Our 10-year historical average market cap to GDP ratio is about 76%. Currently, we are trading in the range of roughly about 55%, give and take 5% here or there. We are trading 27% below our historical average. All-time low-level valuation was 43% in October 2008 when Sensex touched 8,000. We are trading about 21% premium to that. Now, we know that at 27% lower historical average, market has become cheap to invest. But we must also remember that markets had gone all the way down to 43% when there was only financial crisis. So the best thing for any investor is to be overweight equity right now because you are getting it at historical discount. But at the same time, keep some dry powder in case market falls further from here. The third way to look at this, again for common sense, is market is now time travel machine. We had all read H.G. Wells' famous novel on time travel as a kid, and we had fantasy about it. Now, market is actually giving you that opportunity. You can go back 4 years to buy large cap stocks because Nifty 50 is trading at 2016 level. You can go back 6 years to buy mid cap stocks because Nifty mid cap 100 is trading at 2014 level. And you can go back 9 years to buy small cap because Nifty small cap is trading at 2011 level. You look at from market cap to GDP ratio, price to book basis. You look at from historical level point of view. You look at anecdotally based on what is discounted by the market. It does signify that this is time to be overweight equity, but please don't make lump sum investment because markets can correct further. This is a medical crisis, and unless we get medical solution, we cannot be sure that market has made a bottom.
Thank you, sir. And very well resonated, and I can correlate it to what Howard Marks mentioned in his recent memos that all of us have same information at this present time and same uncertainty about the future. So thank you for giving it input on valuations. So next come the flows part, and I'll try to club two questions here. So one is about FIIs. If we look at the behavior of FIIs, and it's not only restricted to India, it's with respect to all the emerging markets. And what we understand is that emerging markets versus developed market, we are at almost 6 years low at this point of time. So how do you see FIIs, looking at India or emerging markets in general? Now, my second question is about foreign direct investment, where I would want to quote Mr. Uday Kotak, which he tweeted 2 days back, that China is the factory of the world and India can be the offices of the world. So how do you see flows coming into India through foreign institution or foreign portfolio route as well as through foreign direct investment route?
So if we see two of the oldest civilization, India and China, China gave Wuhan virus to the world. India gave hydroxychloroquine tablet to the world. 70% of vaccines are manufactured in India. No matter who discovers vaccine against COVID-19, it's likely that it will be manufactured in India. Will this create tremendous goodwill for India? एक कंट्री ने दर्द दिया लोगों को, एक मरहम लगा रहा है, एक ने दवाई दी. We have to encash that goodwill, and that can be encashed in two formats: foreign portfolio investment, foreign direct investment. There are two agencies which creates indices for investors: MSCI and FTSE Russell. Both of them, after a lot of persuasion by the government of India, has agreed to increase India's weightage by 8% and 17% respectively between 30th June and 30th September. MSCI will do from here till 30th June, and FTSE Russell is likely to do from here till 30th September. This increase in weightages is likely to bring money from foreign portfolio investors into India. Second, apart from index, I need to attract money by showcasing my growth opportunity, by showcasing my valuation and my return potential. If we bring our house in order, will we see more foreign portfolio investments coming to country? Undoubtedly, yes. The third is foreign direct investment. The second is foreign direct investment. Now, here, what we have done with Tata Motors in Sanand needs to be replicated. If you remember, Tata Motors wanted to settle down in Singur. They tried hard, didn't work. Finally, they were thinking of moving out, and they got a Suswagatam message to settle in Sanand. They came to Sanand, land was given, power connection was given, infrastructure was developed, approvals were given, 24/7 helpline was there so that they can work round the clock. In 18 months, Tata Nano Motors started rolling out of that factory. If entire India follows Sanand model in inviting companies from abroad and settling them down in India, we have a great opportunity. If you are going to follow Singur model, then we have no hope. I hope and pray that India follows majority of Sanand model. Little bit of Singur model will have to live with it. But overall, we can capture foreign direct investment by approaching or following Sanand model.
Thank you so much, sir, for making it very lucid for us to understand that. So my next question is going back to textbooks. We always studied that whenever any country gets into the path of fiscal expansion as well as monetary loosening, these two are good cocktails for equity market appreciation. While we do understand we don't have that kind of bandwidth like what developed countries like United States have in terms of stimulating their economy, but going by the current scheme of things on what finance minister and central bank has done in India, what do you think are certain steps which can be taken to boost consumption in India? Because we feel that will be the key driver for our growth of GDP in next few quarters. So are the steps enough, or there are certain steps which can be taken without putting too much of pressure or on fiscal and get growth back on track?
So, Harsh, if you see one-day international or T20 matches, let's say Rohit Sharma and Shikhar Dhawan are opening. Now, if both of them go berserk right from beginning, then it's very good from a run rate point of view, but it's not necessarily the best opening. Ideally, we have seen that one guy goes for the bowlers, he starts scoring run rapidly, and other guy provides anchoring. He anchors the entire inning. This happened with Krishnamacharya, Srikanth and Sunil Gavaskar. Srikanth will go after the bowlers and Gavaskar will kind of play down. This happened with Virendra Sehwag and other batsmen. Now, India is the only country in the world which has ability to fire different bullets to contain damage of coronavirus. As we speak, India's interest rate on policy side is 4%. On 10-year government security side is upwards of 6%. And lending rate for corporate India will be, lending rate by banks for corporate India will be upwards of 8-9%. We can lower them by significant margin to contain effect of coronavirus. Second, as a country, our debt to GDP ratio is 70%. We have ability to expand our fiscal situation to provide support to economy. Third, we are sitting on a lot of dead assets. For example, Indians own between 1.5 to 2.5 trillion worth of gold. No one has a clue as to how much gold we own. We still have to open Padmanabha Swami temple vaults and similar vaults in private individuals' pockets to figure out how much gold Indians own. Now, this gold is savings of centuries, but it's all unaccounted. how do we bring this unaccounted gold into mainline economy so that we can support our GDP growth? The same way, government also sits on a lot of dead assets. For example, Government of India has a office called Custodian of Enemy Property. It has about 9,000 properties valued at more than 1 lakh crore. Now, this is the time to encash those properties and use that money to fund GDP growth. So, unlike many other countries where interest rates are already zero, so you can't go and cut it. We can cut repo rate by 400 basis points. We can cut lending rate for corporates by maybe 800, 700, 900 basis points. We can increase our fiscal spending because our debt to GDP ratio is not that high. And more importantly, we can monetize our dead assets like gold, like custodian of any property to fund the investment requirement of the economy.
Thank you so much, sir, and a lot of fresh perspective which came, from your answer, and those are really certain areas for us to focus upon. So now, you have discussed about macros, you have discussed about equity market in general, you have discussed about flows. Now, one key parameter for any investor is investor's own behavior, because that is a controllable variable while everything else is uncontrollable variable. So maybe I'll request Megha to ask a few questions on the behavioral aspects of investors.
Thank you. And thank you, sir, for your fresh perspectives as always. So the first question that comes to my mind is that while we do the risk analysis of an investor before we start, investing for him, both in terms of his ability to take risk and his willingness to take risk. However, it is, these black swan events like COVID-19, which actually help an investor analyze his true risk appetite. And more often than not, we feel that, he has always overestimated his willingness to take risk. So how, as an industry veteran, would you advise to tackle situations like this, assuming the ability to take risk has not changed considerably?
So many a times I have seen that people actually need a hand to hold. People need some comfort and some logic. It's like a doctor. When you visit your family doctor, half your fever goes just looking at him. 1/4 goes away because of medicine. And 1/4 goes away because he gives you saying that this is viral fever, this is monsoon, some logical explanation. The same thing applies for mutual fund distributor or advisor. Most importantly, be there for your customer. He just needs that comfort that there is someone behind me, someone with me to support him. Second, obviously, he needs some reasoning. When you say, sir, market is time travel machine, he understands this. When you explain him market cap to GDP ratio, he understands it. When you explain him airline stocks of 9/11, he understands that. The third thing, apart from logic and reasoning and being there to support, is a mental comfort, a confidence, saying that, look, in 2008, didn't you saw massive destruction of your wealth? Index came from 21,000 to 8,000. Mutual funds NAV came to 60, down by more than 60%. But what happened? Before index touched 21,000, all mutual funds were above their all-time high index. So trust the fund managers. They know what they are doing. They are going through tough time, no doubt about it. But if actual situation is far worse than today, then only markets will fall. If actual situation is better than today, then you don't have to worry about it. So this being there, providing logical reasoning, providing comfort will ensure that customer, investor will stay invested. He won't convert his notional loss into real loss.
Right, sir. And so another challenge which most of our investors today are facing is that they come with different sector in which they do their day jobs. So, for example, we will have some of our clients clients in aviation, some of them are from hotel industry, which are definitely the most worst affected industries as far as COVID-19 situation is concerned. And what's actually happening is, because you call it availability bias or recency bias, they're trying to extrapolate the whole situation in their industries to the entire economy. So what would your advice be to those investors who are probably having too much of opinion overload and information vacuum in times like this, so as to they are not really following the herd mentality and sticking to rational decisions at this point in time?
So one is the question of diversification. If I'm working in aviation industry, my investment should work in non-aviation industry, because if aviation does well, anyway my salary will be taking care of that. And if aviation does bad, then my investment should be taking care of me. So I must create a portfolio which is away from my existing industry. If you are working in tech industry, try to create non-tech portfolio. If you are working in aviation industry, try to create non-aviation portfolio, and so on and so forth. Second, in the unfortunate scenario where you end up losing your job or you end up getting salary cut because your industry has gone down, then you have to ensure that your investment earns that much extra so that your lifestyle is not compromised. Now, how do you generate that additional return on investment? We can't be like ostrich that the storm will pass away. We have to face the storm. And how do we face the storm? By taking logical, rational decisions. For example, 3-4 months back, we started advocating investment in gold. Now that return has worked very well. Very recently, there was scare on the credit risk fund. And before that, there was negative return in liquid fund. Now, liquid fund negative return was there for 3 or 4 days in the third week of March. On 27th March, when RBI came with monetary stimulus, liquid fund return bounced back, and in one day it delivered return to cover back negative return of 3-4 days. Now, people who redeemed in those 3-4 days converted their notional loss to real loss. But people who stayed back, knowing fully well that at some point of time RBI will intervene, in just 5 days they covered back all the losses. The same thing happened in credit risk fund. Now, obviously, in credit risk fund, time to remain invested is not 3-4 days; it is slightly longer. But looking at 3 months negative return on credit risk fund, you can't ignore 3 years positive return on credit risk fund. So when you are faced with challenge, you have to apply rationality and logic. You have to remove your emotions, take a call based on what you think is fair from a valuation point of view rather than from emotion point of view.
Thank you, sir. I think it helps because most of your examples you have given are again from very recent past, and we may be able to kind of resonate with them. I remember in one of your calls we had with you, you mentioned, during the 2008 global financial crisis, when the markets went from 20,000 to 12,000 odd levels, most people were averaging. However, when the markets fell from 12,000 levels to 8,000 levels, they started, kind of panic selling. Now, this could be a probability going forward as well. So what would your advice be, other than seeing, valuation and, market prices? Because that is something which we see. But when it comes to execution, we typically follow the herd mentality and we play the momentum game. So what is that one piece of advice you would give to our investors to avoid knee-jerk reactions, when the momentum is against you or the volatility is against you?
So the 3 guru mantras for successful investing is regular investment, long-term investment, and disciplined asset allocation. Regular investment is continuing with your SIP unless until you have financial emergency. Long-term investment is taking a call 5 years, 10 years, 20 years down the line rather than 5 days, 10 days, and 20 days. A disciplined asset allocation is investment across debt, equity, gold, real estate, and offshore assets. This was true before COVID. This is true after COVID. And 2008 experience suggested that only. There were 3 or 4 sets of investors. one who was completely unaware of what was happening in financial market, they just continued with their SIPs. Their returns over a period of time turned out to be quite good. There was another set of investors who maintained fairly disciplined asset allocation. So from 15,000 to 21,000, on the way up, they were sellers of equity. And from 15,000 to 8,000, at every level, they were buyers of equity. Obviously, their return was the maximum, even though in the initial phases, they lost out. When market was going from 15 to 21, and you were sellers at every level, you lost money. But when markets corrected, you recovered all the losses. When you started investing from 15,000 to 8,000, you lost money at every investment in the short term. But overall, when market bounced back, you recovered. So that was the best strategy of disciplined asset allocation. The third is people who, aided. So they didn't do anything from 15 to 21. They were very happy when their portfolio was doing wonderfully well. At 21,000, they didn't book the profit. When it corrected to 15,000, 14,000, 13,000, they were losing money. They just stayed invested. They neither bought at 13,000 nor at 8,000, but they didn't redeem also. And those guys again did pretty well, even though they couldn't take advantage of lower prices. There were people who got panicked. They had not sold at 21,000, but from 12,000 to 8,000, they moved out, hoping that they will be able to invest in market when market corrects further. Well, my guess is that people who sold at 12,000 couldn't average at 8,000, and they just missed the rally of their lifetime. So what we have seen in 2008 experience, a disciplined asset allocation, a regular investment ends up benefiting investors far more than trying to time the market. In those days, there was one very marquee broking house. At 21,000 Sensex, they predicted 25,000 Sensex. At 8,000 Sensex, they predicted 6,000 Sensex. They went wrong on both the sides, and they were a marquee reputed research house. There was a legendary fund manager. At 21,000 Sensex, he was invested 100% in equity. At 8,000 Sensex, he was 40% in cash. Now, again, you went wrong on both the sides. Don't try to time the market. It's impossible, even for a marquee research house, legendary fund manager. Try to follow this simple principle of regular investment, long-term investment, and asset allocation. That will be good enough for you.
Thank you, sir. I think, it is basically patience, discipline, and long term, which definitely goes a long way in making returns. So, coming back to my last question, which is, it is a fundamental fact that good returns and good information have a negative correlation. They never move in sync with each other. So, if I were to ask you on a scale of 10, with 10 being the highest and 1 being, how are you plotting opportunity and fear in the situation and with the information that we have at present?
So undoubtedly, in the short term, news flow is going to be positive as well as negative. We will see medical breakthrough getting announced sometime, and we will see no medical breakthrough announced sometime. We saw Moderna vaccine getting rave reviews, and then we saw Moderna executives selling the shares. We saw University of Oxford vaccine getting positive news. We saw it getting negative news. We saw hydroxychloroquine tablet getting positive news, then negative news. So positive and negative news will continue on medical side. On fiscal stimulus, same thing will happen. When PM announced 20 lakh crore package, market went up. When FM started giving details, market got disappointed and fell. Same thing happened on monetary stimulus side. So news flow will be not consistently negative, not consistently positive. It will be mixed. And markets will swing like a pendulum between hope and fear, between pessimism and optimism. And which is where my recommendation is that don't try to time the market. You take your asset allocation call. Looking at long-term historical averages, this is time to be overweight equity, but not in a lump sum manner. This is time to be invested on a gradual basis, calibrated basis. Also keep some options open on gold. Generally, when interest rates are low and liquidity is high, gold does well. It did well during 2008 to 2011. What prevailed in 2008 to 2011, the same conditions are likely to prevail in 2020 onwards. So keep some allocation towards gold. That combination of overweight equity and gold should deliver good return to you once medical solution emerges.
Thank you, sir. So I think the biggest takeaway that I have from you is, analyze your situation in your given perspectives and your unique circumstances the most. And as long as you're doing that, I think it should be beneficial for a long-term investor. I think Harsh can do the closing remarks.
So thank you once again for the
Absolutely.
time taken out by you on a busy day. And what we really liked about the conversation with you, and what I'm sure our investors will also like, is certain examples which are easy to relate to, be it about time machines, be it about cricket examples, and those are the fresh perspective which we get it very rarely, and thank you for those.